So Charles actually just has some news. He just raised a new fund for Precursor Ventures. It's your second fund. I remember when I first met you, you were talking about your first fund.
That's right.
So tell us what you're going to do with this new capital that you raised.
Yeah, we're going to stay pretty true to our mission. So the way Precursor started, I was a partner at SoftTech Uncork with Jeff Clavier for about 5 years. And it just felt to me like the seed ecosystem was getting much more focused on companies that were post-traction, and I felt like there was a need for capital for founders who were earlier in their journey, who needed $1 million or less to kind of get from 0 to 1. So we're going to continue our mission of funding 20 to 30 companies a year with a check of $250K for that sort of pre-traction, pre-revenue round. And so far it's going pretty well, and with the bigger fund, it means nothing changes on the front end. It just means we have more in reserves to support companies that need more money, time, and effort from us to help them get to the next level.
What qualities are you looking for before you write that first check?
Yeah, we spend a lot of time about this. We just added a third person to our team, so I've spent a lot of time trying to write down things that are in my head about how we choose founders. For me, one of the big things is someone who has a unique insight. And so what that means is someone who spent time studying a problem and has a set of insights or perspective on the problem that are not obvious to someone who studied it for 5 or 10 minutes. So we spend a lot of time trying to figure out what is the unique, special thing that this founder believes or knows about his or her market that the average person doesn't know. And then the second question I ask is why this market? Is this a market that's amenable to startups?
And it's no secret that people of color, women, older people are underrepresented in the venture capital industry. Why do you think that is? You've been in the industry for a long time.
Yeah.
I'm sure you've seen a lot.
I'm older than I look. So I think one of the biggest things I've noticed is venture capital is a really risky business. You're giving money to people at a really early stage in their journey. And so I think a lot of people are looking for comfort. And comfort can come in a lot of different ways. One way people feel comfortable is people who look like them, people who went to the same schools they attended, people who live in their neighborhood, people who are in their fraternity or sorority. I think a lot of investors are always looking for elements of comfort, and that comfort oftentimes comes from shared experiences or shared backgrounds. And if you think about a lot of people of color, they didn't work at the same companies where VCs work. They didn't go necessarily to the same schools. They don't live in the same communities. They don't have the same social intimacy with these folks. And so it can make you feel, no pun intended to the audience, like foreign. Like you come from a different place and a different background. And I think for some investors, that's a hard thing to overcome when you're writing a check.
Yeah, and you went to Stanford, but we were talking backstage,
Yeah.
and you admitted that that's helped you. It's definitely something in this industry where if you went to the same schools as certain people, you have an edge. But if you didn't go to Stanford, what can you do to break in?
Yeah, I think about a lot. Like my life is interesting. There aren't a lot of black venture capitalists in the world, period. But I also have the Stanford card, and there's sometimes I'm in the room and I understand that I'm here because the fact that I went to Stanford opened a door for me that maybe wouldn't have been open. And when I think about breaking through to venture, I think it's a lot better now than it was 10 or 15 years ago when I got into venture. And I think that's true for a couple reasons. I think one of the big things about breaking in on the venture side in particular is I think having a really interesting point of view about a market that you want to go after. And I think the internet today makes it a lot easier to share your views on things, whether it's Twitter, whether it's writing, whether it's podcasts, or whether it's the work that you do. I think it's a lot easier, not easy, but easier to showcase that you have expertise in some domain.
And if you're an entrepreneur trying to get your attention or just VC's attention in general, what are some tips?
Yeah, I've thought a lot about what are some tips that, I can only tell you what works for us at Precursor. I think there's this notion in venture that a warm intro is the only way to get in front of a venture capitalist. I think, look, if you have a really good warm intro, if you know somebody that we've backed who's done really well in our portfolio, or you're friends with someone I'm friends with, that's really a great way to get to me, but it's by no means the only way. And honestly, I would rather have a well-written cold email than like a mediocre lukewarm intro. And a lukewarm intro is someone who I sort of know says, oh, I sort of know somebody. I met them for 5 minutes in the line to get a drink at Founder Embassy, and they seem like a nice person, you should meet with them. Honestly, I think you could probably represent yourself better by writing me directly, and I'd say about 5 to 10% of the meetings I take are with people who just say, hey, look, I don't know you, I'm not connected to your social network. I have a business that I think is relevant for Precursor's focus and stage, and I want to get your feedback. And I feel responsible that if somebody writes me a well-written cold email, that I should get back to them. And there's people in this audience here that I recognize by face who've cold emailed me, and we've talked. And so not every venture fund is that way, but I think increasingly I'm meeting more VCs. They won't tell you this on stage because they don't want their inboxes to blow up. But I do think more and more investors I know are open to the idea that good people with good ideas are outside of their network, and you can use cold email effectively to reach them.
So what kinds of things are in these well-written emails? I mean, the thing that's hard about the early stage is a lot of times your business idea will eventually pivot anyway, so it's not just about the idea, there's got to be more than that. Or is it?
No, it's a really good question. So the things that I think make the good cold email stand out to me, one, it's stage appropriate. So every now and then I'll get someone who says, we're raising a $20 million Series A. I'm like, well, that doesn't what we do at Precursor. So clearly you haven't put any effort at all into figuring out what we do. So it's got to be stage appropriate. We're a pre-seed firm. We mostly do rounds of $1 million or less. We try to make it really clear what we do. So one is it's stage appropriate. Two is the idea clear? You'd be surprised how many times people send me a 3-paragraph email and I go, I still don't actually, they'll say we're using AI and ML to disrupt this product. And I'm like, I still don't actually understand what the product is that you're building. 3, if you've made progress, be really clear. Hey, we're post-launch. We have some early traction. If you haven't, just be honest. We're looking for money to help us get from this internal prototype to a launch product. But for me, the whole question is if I spend a minute and a half reading this email, can I get a really clear picture of who you are as a founder, why what you're doing is interesting, and that you're stage appropriate for me? And then sometimes I'll take a meeting. Other times I try to write people what I hope is useful feedback about why it's not a fit.
And when we've talked in the past, you've mentioned you don't just invest in people of color, but you feel like, because of your experience and who you know, that you're going to help contribute to the ecosystem and help, find more of these talented people that haven't been discovered. Yeah, can you elaborate a little bit more on your approach there?
I think we're in a weird place in Silicon Valley right now. I think 10 years ago, people were like, Silicon Valley is a meritocracy, good ideas, blah, 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 that whole thing. I think now people have recognized that there are substantial communities in the Valley for whom that's not true. I think we're still trying to figure out, well, what do we do about that? Now that we've established it's not true, like, what do we do about that? And I can only tell you what's worked for our fund. One of the first decisions we made when we launched Precursor was, I think a lot of VC funds say, we're all about the people, it's about the founder, and you go to their website and it's all company logos. And I just said, well, if we're really about the people, then why don't we make our website reflective of the community of people that we've backed? And my goal is that I wanted to have a founder community where any person, no matter what they look like, white male, black female, could look at the collage of faces on our website and say, oh, I see at least 1 or 2 people who look like me. And I always ask myself, I go to some of the websites of firms that I admire and respect with people that I co-invest with, and I look at their websites and I go, I don't know if I would approach this firm if I were an entrepreneur, because when I look at all of the staff page, all of the team page, all of the portfolio company founders, this is not a firm that's signaling to me that like they're making an investment in people that look like me. So I think, I'm really committed at Precursor. We're oftentimes the first investor. And my view is if at the pre-seed angel stage, if you can't change the backgrounds that you back, you're just not trying hard enough. Or it's not actually that important to you, because we're really backing people based on our subjective assessment of their capability as an entrepreneur and the idea that they've chosen. And I'll tell you, sometimes with people of color or entrepreneurs who I think have limited access to capital, I'll tell them, I really like you. I think the idea that you're going after is not a good one for VCs. And if you ever want to come back with an idea that feels more VC appropriate, I'm happy to keep the door open. But doesn't mean you shouldn't work on it. You should just know that you're maybe working on an area where VCs are not attuned. I think the one big area that no one really talks about, though, in the Valley is age. We have some founders in our portfolio that are older. And by older, I mean like north of 40, 45, which by Valley standards is older. And I see that they get a really different set of questions asked about them in their fundraising. Do they have the passion? Do they have the drive or energy? I think that's code for like, I think this person's old and that they won't work as hard. And so I think once we finish tackling some of the big problems that are in front of us, I think age is going to be one of the next big ones we have to address.
Yeah, that's starting to be talked about a little bit more. So what organizations or networks are out there right now to help people from underrepresented backgrounds meet more people in the industry?
Boy, there's actually a lot of really interesting work being done. I think there's some sort of macro programs. I think Code 2040 continues to do really good work in this domain. I think All Raise is doing a tremendous job in trying to promote more female investors in the world of venture capital. But I think the thing that's sometimes hard to appreciate from the inside is that venture capital is a really slow business. Like, it changes really slowly, which is a problem. It means that it takes, even with the proliferation of promotion of women to leadership positions in venture, that promotion hasn't yet translated into female entrepreneurs getting the share of dollars that I think they deserve. And I think that will happen quickly in venture, which in venture is like 5 years. And so I think it's just a slow-moving conservative industry by nature. And so making change rapidly is really difficult.
And what about for people who want to be investors themselves, not just entrepreneurs? What are some tips for breaking in the industry on the investment side?
Boy. Being a VC is really different. So I've had 3 or 4 startups of my own. Venture capital is a really slow business in the sense that, like, I make investments, an investment I make today, I don't expect to really bear fruit for 7 to 10 years. And it's really different than being an operator, whereas many of you in the room are founders or executives in your companies. You can come in, make a decision in the morning, maybe you change some copy on the website, you do an A/B test. You might actually get data back that same day. Venture doesn't work that way, and venture partnerships, I'd say, overall are slow to hire. So I would say if you really want to become an investor, if you have the means to make even small angel investments, that's a really good way to find out if you enjoy investing, because investing is different than operating. I'd say second, if you really want to get into venture, remember it's a relatively small industry. The good news for you all in the audience who might be thinking about careers in ventures, we're having an explosion of brand new venture funds being formed, who I think are looking for people with different profiles and backgrounds. I think it's important to understand that being a good investor is different than being a good operator. So I would say lots of VCs are happy to engage if you have points of view on their portfolio. I would say the best way to show up on a VC's radar screen and to get their attention for your future venture investing career is either be an advisor to good startups, be an investor if you have the money, or be a resource. So I have people on my network who are not investors, they don't have the capital to be angel investors, but they have a knack for spotting really talented founders that are outside of my network. And those people bring me leads all the time, and I pay attention. Wow, this person sent me 3, 4, 5 really interesting startups. This is a person who has a knack for discovering really good companies, and that's something you can do even without a balance sheet.
Let's say you're an associate or something at a venture firm. Given that it takes a long time to actually really know if your ideas turned out to be good investments, how do you get promoted?
This is, I think, the literally million dollar question in venture capital, which is this path from junior person to person with check writing privileges. And I don't have a good universal answer. I mentor a good number of mid-career venture people who are thinking about making the jump. And I think if you ask most general partners, why would you promote a junior person to a full-time independent investing role? Usually it's because they found 1 or 2 really special companies during their time at the fund. And so I think the problem with venture is a lot of times we wait until we have undeniable evidence that somebody's good before we promote them. And I think this is going to change because 10 years ago, it was very hard for people to move in between firms. Like, it wasn't common to see a partner at one firm go to a new firm, or an associate at one firm go to another firm, or 2 partners from one firm spin off and start a new firm. I've never seen this level of movement between firms in venture. And I think this is a great time to be a top performing junior person, because if your firm won't promote you, there's a lot of other firms out there that are looking to grab other people's talent. And for a long time, that was taboo in venture. It isn't anymore. You're seeing more movement than ever. But I think the skills you need are, you need demonstrated ability to source really great opportunities. You need the ability to, once you source them, to actually navigate the process and win. You need to be someone who entrepreneurs count on and think of as a resource. And I think you have to have a brand for being known for something in the industry. If you can master those 4 things, you'll be in really strong shape.
And so when it comes to the fundraising environment, there's a lot of money in the industry, but it's actually a lot of it's at the later stage. So when you look at these, numbers that say, wow, more money is being invested than ever, that's a lot of times if you're already a unicorn. So how's the fundraising environment for the early stage?
I have this conversation with companies that we've backed all the time, which is you read the headline numbers about the amount of money in venture capital, and like Katie said, so much of that money is post-traction. So I think we're in this very weird time in the market where once you have a company, and this is obviously very self-serving, but I think it's true, once you have a company that has traction and metrics and some evidence, there's probably 10 to 20 times this number of venture capitalists who are interested in funding that business as there are pre-traction. So I think if you're a company that's just starting, particularly if you're a person who's not from the Bay Area, who's not connected to capital, maybe bootstrapped, you can read the headlines and say, my experience is that there's no money out there for companies like me. Whereas if you're Uber, Airbnb, Lyft, or a late-stage company, it feels like there's unlimited capital, and it's this really weird paradox. So we have more companies than ever in our portfolio who I think are within spitting distance of break even, and I've told them, I think we should maybe go to break even. Rather than try to push this rock up the hill and try to convince venture capitalists who don't understand your business that they should be excited about it, maybe we should take our destiny into our own hands. And I think there are more and more companies in our portfolio that I'm seeing where that's an opportunity for them, and I'm encouraging them to think about it.
What do you think it takes to get from the seed stage to a Series A?
Boy. So I think a lot of companies I work with, they go, oh, I read on a blog that I need $100,000 a month in recurring revenue if I'm a SaaS business. I think it's better to reverse the equation and think, what's a Series A investor trying to do? Your typical Series A investor is going to make 2 or 3 investments a year. And they're going to take a board seat kind of every time. So the real question is the business that you and your team are building, do you think it's really going to be one of the 2 or 3 most interesting things that the person across the table from you is going to see during the year? And I think it's hard to know that as a founder. And so what I tell people is, I think things like $100,000 in monthly recurring revenue with good growth and low churn for a SaaS business, or tens of thousands of active users for a consumer app with really high growth, those are sufficient to get you a meeting. They're not necessarily sufficient to get you money. And my real thesis is, I don't actually think Series A people know what they're looking for until they see it. And so the trick is, can you get enough points on the board with your company, answer enough of the open questions so you can get in the room and prove that you're one of those. And I think private company valuations are going up in some ways faster than public company valuations. And so we're not seeing, at least in our portfolio, except on rare occasions, a real frothiness around acquisitions. What I have seen is there's a handful of strategic companies in certain industries that do not have internal R&D capabilities who are voracious acquirers of startups. So I think you're seeing this in the CPG and consumer goods space, where lots of startups that go direct to consumer or have alternative retail channels are really threatening some core businesses in CPG. I haven't seen it in software as a service, and my whole theory is in enterprise software, IBM, Oracle, SAP, and Salesforce, they're still really strong. And there aren't that many startups out there right now that I think are existential threats to their core business.
Got it. Well, and I promised I'd leave time for audience questions. So who has a question? No one? No questions. All right.
We got one.
We got a
one down here. Yeah. Oh,
I think his question was, what was the moment in life when you decided you wanted to be an investor?
I remember this moment clearly. My last startup was not what I would describe as a huge success. I ran a games company. We got to 12 people. We made some money on Android, but it wasn't big enough to go on. I spent about 60 days of zero cash trying to sell the company, and we found an asset buyer at the last minute. It was exhausting. And I was in my mid to late 30s at the time. And we shut that company down after we sold the assets, and the people have all gone on to do great things. And I remember sitting in my apartment thinking, I don't think I want to do that again. And I'm like, that is like being a founder. It's just a grind every day. It's super hard, and it's a big challenge. And I looked at myself and said, I don't know that I have another 5 to 7 year grind in me to do that. It requires so much dedication and focus and commitment. And I just said, I think I'm ready to retire and be an investor who advises startups on what to do rather than be the person in the arena. And so I remember how hard it was, and it was a very clear moment. I was like, I don't want the next 5 to 7 years of my life to be like this. And that's the level of commitment and effort that it takes if you're going to do this properly.
Wait, I thought you said that older investors shouldn't be judged by not having enough energy to do another business.
I will freely own that I quit the startup game because I wasn't tough enough. So.
But yeah, any other questions? Right here in the front row. You're doing a stand up. So we said, how long does it take you to get to know a founder before you invest?
Yep, good to see you again, man. Yeah, so I would say I can give you the range. The fastest has been 2 days. The longest has been 2 years. The 2 years was someone I literally just didn't know at all. And they were working on a problem that I didn't understand at all. And they didn't have any evidence that what they were building was going to work. And so I was just like, I don't have anything to go on here. Like, I don't know you. I don't know the market. I don't have a sense of what the product is. And I don't have any conviction here. And that person we've met up a couple times a year for 2 years. And finally, I just got comfortable that she was the right person. The one that was 1 day, the person just had such a clear, it was 2 days, had just such a clear description of what they were building. It was already kind of working. And I was like, I think this person might be the only person in the world who understands this problem with this level of depth. And so it was weirdly an easy yes, because I think the thing they were building was just really clear to me. Yeah, so that's kind of the range. I think typically, most of the people I invest in, though, I didn't know them for a really long time before we invested. Maybe, like, I'd say the median is probably 2 months, and the mean is probably, like, I don't know, like, about the same.
What was the 2 days one?
Oh, I don't know if I should admit what it is.
Scooters?
I will broadly tell you. It was a consumer app in a segment with virtually no competition, where this founder has spent her entire life basically studying this problem.
Okay, all right. Well, thank you so much. Appreciate your insight as always.
Good to see you.